start here in a minute. I know got a good group. There's a great excuse to be watching us take us through the market, considering it's 7 degrees out here, and it's even worse than where Maddie is in the Midwest. At least I'm to understand that. But again, we've got folks in a handful of different time zones. We'll let everyone get settled here. Some people still eating lunch. Some people wrapped up lunch. Some people probably getting ready to go out for dinner. Um, just give us one moment. All right, we got a nice looking crowd here. We'll get started. Thank you for attending. For those of you who don't know who I am, I'm Jeff Hansen, managing member of the Breakwater Capital Group. Today, we have the good fortune of having all three of the team members to take us through the quarterly market update. This is a recap of 2024, mainly the fourth quarter, but some rounding out of the whole year, and then our best guess or best thoughts when it comes to 2025. I think guess probably is appropriate. A little bit of background of the firm. We've been in business here just a little under 3 years. That'll be 3-year anniversary in June. We manage roughly 300 families' assets, about 800 million across those families. We have an office in northern New Jersey, one in Massachusetts, just outside of Boston, and then Denver, where you find Maddie today. We're a fiduciary. That means we put you first and foremost. We do not sell a product. We sell ourselves. It's a service, and we're here to provide a world-class experience. So we want to just quote our sources for today. We are fortunate that we have a number of different resources that give us timely content. You'll see a number of them here. If there's certain information that's of interest to you, feel free to reach out to us individually. We're happy to send you specific parts of the presentation. The actual presentation itself will be recorded, and we'll be sending that out to those of you in attendance and those of you who couldn't make it today. But we do appreciate the time. We're going to try our best to keep this to an hour. Generally speaking, we don't do a good job of that. We're usually around an hour and 15 minutes, but let's dive in. There was a lot of ground that was covered in the last 90 days of 2024. We had a historic election. We had a dollar, ripping, and again, those things are very much related. Market hit all-time highs, I believe, 57 times last year, without any real correction. We had a couple bumps along the way. For those of you who are trading crypto, giving each other high fives as we talk, the most popular cryptocurrency hit 100,000, and I see all sorts of crazy stuff that calls for it to get to 1 million. It wasn't all peaches and cream. The last month, December in particular, was a little choppy. We saw a fairly large spike in bond yields. Again, counterintuitive when the Fed had cut rates 3 times in the last part of the year. A lot of that was driven by just future growth expectations and some concerns about restoking inflation. So we've heard a lot about this kind of concept of term premiums, which is essentially the excess yield you'll capture above and beyond, the risk-free rate, which is on short-term paper, and then the neutral rate, which is this kind of, I guess, Shangri-La, for lack of a better saying it, where the Fed has found kind of a happy medium where we're not tightening or not easing too much within monetary policy. They cut twice in the fourth quarter, in November and December. Their projections from the summary of economic projections themselves, for the redundancy, call for 2 rate cuts this year. If you remember this time last year when we were going through Q4 of 2023, the prognosticators were calling for 5 or 6 rate cuts. We'll see what happens again as the year plays out. Labor markets continue to be pretty resilient, impressively so. We have some challenge in the near term given the wildfires in California, but we'll see how that shakes out. Earnings, we're in the midst of fourth quarter earnings season. This will be the last earnings report for 2024, and earnings are set to grow somewhere in the neighborhood of about 10% of the year, 12.25 or 12.5 for the quarter, and then estimates for 2025 are as high as 14%. GDP is coming around 3%, give or take, but the markets reflect that, right? We're at 21 times, almost 22 times, and again, that's by no stretch of imagination a cheap multiple. We'll see what happens, again, overseas, where stocks didn't fare nearly as well. Tom will take us through that section of the deck. And again, we had a little bit of volatility in commodity prices, specifically oil and gas in the fourth quarter on the back of supply concerns, and also this cold weather, right? So let's dive in. Maddie's going to kick us off with a macro update. Appreciate you guys again taking the time with us.
As always, we want to take a pulse check here on the different components of GDP. So first, this slide really walks through the contributors to real GDP growth for the recent quarters, including Q3 and Q4 of last year. The chart shows a breakdown of how various components like consumption, business investment, government spending, residential investment, net exports, and inventory changes all contribute to overall economic growth. You can see that in Q3 of 2024, GDP grew at an annualized rate of 3.1%, with consumption remaining the primary driver, as always, contributing 2.5 percentage points to growth. Business fixed investment and government spending also added positively. Well, you can see that the net exports and inventory changes detracted from growth. This is consistent and positive trends in GDP, and they highlight the resilient consumer spending, as Jeff, had sort of just alluded to, bolstered by a strong market and strong job market, and wage gains. Investment and government expenditures continue to provide stable support for both of those things. Net exports, as always, remain a challenge, reflecting ongoing trade dynamics, as we'll hear more about from the current administration. And certainly, as we move forward, monitoring all of these components will be essential in understanding how 2025 economic landscape will start to shake out. And if we move on to sort of peeling back that onion with unemployment and wages, this slide illustrates the trends in unemployment rates year over year, wage growth over time, providing certainly important context for the labor market for the fourth quarter of last year. As of November of last year, the unemployment rate stands at 4.2%, which is below the 50-year average of 6.2% that you can see in gray there. This is an indicator that continued strength in the labor market, though we've seen the unemployment rate has risen slightly compared to its post-pandemic lows. Year over year, wage growth remains steady at 3.9% that you can see in blue there, matching the historical 50-year average, suggesting that while wage pressures have normalized from their peaks in 2022, that's something that we've talked about consistently, they're maintaining a pace consistent with historical trends. Certainly shouldn't be a surprise to anyone that the quote unquote, great resignation, if you will, has officially sort of come to an end, as white collar jobs are taking on average about 6 months to fill, which is certainly different than what we saw after the post-pandemic hiring craze. And if we look at the balance between low unemployment and stable wage growth, that reflects a relatively healthy labor market. Certainly, it's still crucial to monitor whether wage growth aligns with inflation trends to assess potential impacts on consumer spending and broader economic conditions as we move through the remainder of this year. And if we take a pulse on labor demand, so showing a different side of the labor market here, this slide provides a more comprehensive view of labor demand as of the fourth quarter and last year using the JOLTS survey data. In the top left, you can see that the total number of job openings as of October 2024, job openings have moderated to 7.7 million, down from a significant peak of over 12 million in March of 22. And you can see that the decline reflects a cooling labor market as businesses adjust their hiring plans and evolving economic conditions. Again, just a reflection that resignation is the Great Resignation is over from this data as well. And then on the top right, the quits rate, also that's really often considered a measure of worker confidence, shows that 3.3 million individuals voluntarily left their jobs in October of 24, certainly a decline from the highs that we saw back in 2022, but still indicative of a relatively healthy labor market where workers feel they have certain mobilities and opportunities within the workforce. And in the bottom right, we see layoffs remain relatively stable at 1.6 million, consistent with pre-pandemic norms, suggesting that while hiring may have slowed, employers are not engaging in widespread layoffs, which certainly should be a reassuring sign of stability in the job market. Overall, what this slide really tells us is that while labor demand has softened from its post-pandemic highs, certainly all these metrics point to a market that is stabilizing rather than contracting, with business maintaining a cautious but steady approach as we head into the employment season for 2025. And then if we continue to look at that and look at labor supply, this slide focuses on key metrics highlighting non-farm payroll gains, as sources of population growth and labor force participation trends. On the left, we can see that non-farm payrolls increased by 227,000 in November of 2024, with the three-month average at 173,000, something that we've heard a lot about in the news. But while this reflects a steady moderation from the rapid job gains of the post-pandemic recovery, certainly still suggests a strong labor market that's resilient and supportive of future economic growth. In the top right-hand panel, you see that population growth and different dynamics of population growth. Historically, population growth has been driven by a combination of net immigrants and births exceeding deaths. However, recent trends and projections from the Congressional Budget Office shows a slower pace of growth due to declining birth rates, reduced immigration levels, and certainly the demographic shift presents challenges for future labor supply and economic growth. In the bottom right-hand panel, we examine labor force participation rate changes since the 2019 average. Participation among women ages 25 to 54 has shown obviously a notable increase that you can see there in blue, reflecting certainly a strong re-entry into the workforce. In contrast with that, you can see the participation among men of the same age remained relatively flat as compared to women. And participation among individuals ages 55 and older has declined, but that's driven mostly by retirement, so not too surprising there. So all these factors highlight the evolving dynamics of labor supply and the structural challenges facing the U.S. economy in sustaining a robust workforce over the long term. And then if we change gears a little bit, moving on to consumer spending, we see that this slide provides certain insights into the state of the consumer as of Q4 of last year. On the left, we see the U.S. household debt service ratio, which measures debt payments as a percentage of disposable income. After declining to historical lows during the pandemic, the ratio has been gradually rising, as you can see from that graph, now reflecting increased that we can see on reliance on credit, certainly amidst tighter financial conditions and reduced savings rate that we've been continuously talking about for the past few quarters here. On the right, we see delinquency rates for various types of debt. Credit card delinquency rates have increased significantly in recent months, indicating some financial strain for households. Auto loans and student loans have also seen a modest uptick in delinquencies. If we look at mortgages and HELOCs, delinquencies remain relatively low. Broader picture, consumer spending has been supported by increased borrowing, particularly on credit cards, and savings rates have fallen pretty significantly. Reliance on credit cards and credit debt may introduce certain vulnerabilities to the consumer, particularly if interest rates remain elevated or if economic conditions worsen as we move throughout the year here. If we look at consumer spending in a little more detail here, this slide highlights the trends in expenditure in certain categories and the personal savings rate as of the end of last year. On the left, we see year-over-year changes in real consumer spending and by category. In 2024, spending on services, which accounts for the largest share of consumer expenditures, grew by 3%. Durable goods spending grew by 3% as well, reflecting modest but steady demands for items like vehicles and appliances. Non-durable goods, you can see, saw a slightly lower growth rate of 2%, aligning with a more cautious spending on essentials like food and clothing. On the right, the personal savings rate, which represents savings as a percentage of disposable income, has dropped to 4.8% for 2024 year to date, certainly well below the historical average of 8.5%. And we think that this shows longer decline, obviously, in the longer term trend, as households rely more on credit that you just saw in the previous slide to support their spending. So overall, we think that this reflects a stable yet cautious consumer. Spending remains a critical driver of economic activity, as we saw in the beginning with GDP, but the lower savings rate could signal vulnerabilities ahead if economic conditions worsen throughout the year. As always, we want to take a pulse check on housing. And so we have been showing this slide pretty consistently, but it shows an overview of the current housing markets as of Q4 of 2024, focusing on indicators like home sales, mortgage rates, affordability, and mortgage applications. On the top left, you see existing single-family home sales remain near multi-level lows, as always reflecting ongoing challenges in the housing market. Elevated mortgage rates and high home prices have significantly dampened buyer activity. The top right panel shows the sharp rise in 15-year and 30-year mortgage rates, which remain at historically high levels. Probably not a surprise to anyone on this call. Further, this strained affordability and discouraged new borrowing for home purchases. And the bottom left panel, the Housing Affordability Index, has continued its downward trend, as we've seen for the past few quarters here, highlighting how difficult it is and has become for many potential buyers to enter the market. Rising home costs and borrowing rates have pushed affordability to some of the lowest levels that we've seen in recent decades. And the bottom right-hand panel highlighting the MBA Mortgage Application Index. And despite some recent stabilization that you see there, the lack of a meaningful rebound might possibly indicate that potential buyers remain cautious, likely due to economic uncertainty of where rates are going and where housing prices are going as well. So all these indicators reflect a housing market that's really struggling to find its footing and recover in the face of continuously high prices and elevated borrowing costs. So we'll see how that continues to evolve in the coming year here. And as we look at federal finances and what that means for the government, so this slide provides an overview of the 2025 federal budget on the broader fiscal outlook, highlighting total spending, the deficit, and federal debt projections. On the left, you can see the breakdown of the 2025 federal budget. Total spending is projected at $7 trillion, with the largest components being Social Security at $1.5 trillion, 22% of spending. Medicare at $1.1 trillion makes up 16%, and the net interest payments at $1 trillion, which also makes up 15%. Notably, net interest payments have grown significantly due to higher debt levels and elevated interest rates. Total revenue is estimated at $5 trillion, with the income taxes contributing the largest share at 37%, followed by payroll taxes at 25%. In the top right-hand panel, you can see that the federal deficit as a percentage of GDP, the deficit is projected at 28% of total spending, driven by different elevated spending relative to revenue. Net interest outlays or debt servicing, shown in the blue there, are expected to rise pretty significantly over the coming years, adding to different fiscal pressures. In the bottom right-hand panel, the federal net debt is shown as a percentage of GDP. By the end of 2024, debt is projected to reach 98.2% of GDP and is forecasted to rise nearly to 130% by 2034, assuming current policies remain in place, but we all know that that may change fairly quickly here. This reflects the long-term fiscal challenges posed by demographic shifts, rising entitlement spending, and interest costs or costs of borrowing. And if we look at all of these projections together, certainly it underscores the growing importance of addressing fiscal sustainability while balancing economic growth and critical spending priorities. So we'll see how this administration handles that as we move throughout the rest of the year. And if we look at tariffs, we've gotten a lot of questions on this, so we wanted to make sure that we addressed it. If we look at tariffs on US imports, this slide shows here and provides a historical perspective on average tariffs rates for US goods imports measured as duties collected as a percentage of the total value of goods imported for consumption. So we can see that the tariffs were significantly higher in the early 20th century, with rates exceeding 18% during the 1930s. Over time, tariffs have declined, significantly as the U.S. embraced a more liberal trade policies, participated in global trade agreements reaching lows of around 2% in the early 2000s. If we look more in recent years, though, we have seen a slight uptick in tariffs reflecting shifts in trade policy, including some targeted tariffs on specific countries and goods like China. The dotted section in the right-hand side shows a potential scenario under which the new administration policies could shift to if they decide to go forth with higher tariffs, if trade negotiations escalate or more protectionist measures are set to increase there. Tariffs have a direct impact typically on the cost of imported goods, influencing consumer prices, corporate profit margins, and overall inflation trends. So certainly something that's essential to monitor as the year goes through here. And if we do, we always want to take a pulse check on inflation. We have been doing so over the past 3 years here. But this slide really highlights the importance of inflationary pressures and the expectations for future inflation, focusing on the role of the service sector. On the left, we see year-over-year changes in the consumer price index broken down by key components, including services, excluding food and energy, like staying with goods, rent, food, energy, and core inflation. Notably, the services sector remains the primary driver of inflation, with rent also contributing pretty significantly. Inflation in goods has moderated, even turning negative in some periods, as you can see on the graph there. Services sector persistence is keeping overall inflation elevated. That's also been a theme here for the past few quarters. On the right, we see the 5-year break-even inflation rate, which reflects market expectations for average inflation over the next 5 years. Inflation expectations spiked during the pandemic recovery. They have since stabilized around 2%. That suggests the markets anticipate a return to more normalized inflation levels over the medium term here. Key takeaway that while headline inflation has come down due to goods deflation, persistent inflation in the services sector presents a challenge and continues to be a challenge for monetary policy, and something to critically monitor as we look at the broader picture in achieving more price stability. And as we further look at inflation, this slide provides a long-term view of inflation trends, focusing on both headline and core inflation as measured by the CPI and personal consumption expenditures, or PCE. The left-hand chart tracks inflation rates back to the 1970s, while headline CPI, which includes all components, is shown in blue. Core CPI, which excludes volatile food and energy prices, is shown as in gray. Historically, headline inflation has been more volatile, but core inflation provides a more clear picture of underlying price pressures. In the table on the right, we see recent inflation data compared to the 50-year average. For November of 2024, headline CPI stands at 2.7%, slightly below the long-term average of 3.7%. Core CPI is at 3.3%, showing more persistent price pressures. Notably, energy prices have experienced deflation with a decline of 3.1%. Food inflation has risen modestly to 2.4%. Broader takeaway, inflation has moderated pretty significantly from its post-pandemic peaks, but core inflation remains above the Federal Reserve's 2% target. So what this really suggests to us is that achieving full price stability is going to continue to take more time, especially if underlying drivers like services and housing inflation continue to remain sticky. certainly something that the Federal Reserve will be monitoring in terms of the broader economic outlook as the year goes on here. And the last slide in the economic update here is a chart that illustrates the significant increase in US spending on manufacturing related construction with a dramatic growth trajectory since 2022, as you can see on the chart here. So we can see that spending has surged to nearly 250 billion by the end of 2024, making certainly substantial shifts in investment levels compared to relatively stable trends of the prior decade. And the growth can largely be attributed to different factors like federal incentives for domestic manufacturing, supply chain reshoring, heightened demand for advanced manufacturing facilities. And certainly, this is a trend that we want to continue to understand and is essential in highlighting the evolving US priorities of the US economy and potential ripple effects to things like employment, technology, and some regional development. With that, I will hand it over to Jeff for our equity and commodity market update.
Thanks, Maddie. Appreciate it. Look, we spend a lot of time on the macro, the economic stuff, because that's important. I know we can all get a real-time feed on what's going on in the market, but what's moving the market is really a lot of what Maddie just covered, whether it's labor, it's consumption, it's inflation. So, just quick first slide here. I think this is pretty cool. This is really the market for the year. I know we're going to get more into the granularity of Q4 in a moment, but you can see, on the upper left-hand corner, this is the first time we put back-to-back 20% years up for the S&P since the late 90s. Late 90s had a 5-year run where they're either close to 20 or a little bit over. I'm not so sure we'll hit another 20 this year, but at the same time, again, kind of interesting to see. If you drill down to the middle part, it just shows where a lot of that performance came from. So the Magnificent Seven, we would talk about that. We played some music on, I think, our Q3 market update, or maybe it was our Q2 market update, just highlighting the Magnificent Seven and their role. They counted for they were up 63% last year. So the market's up 20 and they're up 63. You can basically surmise that a lot of the other investments in the S&P weren't anywhere near the 20% the market did. The top 50 stocks had a return average about 32. The S&P itself, again, 23. And you can see, again, I would argue if you come in the year and said to me on January 1st of 2024, if the equal weight, mid cap, small cap, micro caps were all going to be up somewhere between 10 and 12%, I'd be happy camper, right? But again, it was continues to be not the only game in town, but the best game in town, those Magnificent Seven stocks. The slide below, or the last one here on the slide, but probably my favorite, which looks at the percentage of companies in the S&P that actually outperform the benchmark. And you can see like the long run average is close to like half, right? Again, that's a yellow perforated line. But the last 2 years, it's been a quarter. And in those 2 years, it essentially means that, like, again, line share of stocks are underperform the broader market. If you go to 2022, which, if you recall, was a very tough year for technology, or specifically the Magnificent Seven, you'd see a lot of companies outperform the broader market, but again, their role or their size is so limiting that it didn't really move the needle that much. The market ended down that year about 18%. Maddie, I'll have you hop to the next slide. This is, again, sticking with 2024 on a whole. The best day was November 6th, right after the election. Right, the market popped 2.5%, and these are the best performing sectors of the year: communication services. So think Netflix having a good day today, Alphabet, Meta platforms, and some others. Tech second best, and financials. Again, a place we feel pretty constructive about. Had a really good year. A lot of that came in the fourth quarter, and the excitement around deregulation and a little bit of the steepening of the yield curve. Worst day was in August, down 3. It was that Japanese carry trade, right? People have already forgotten about that. We can spend time on that if someone really wants to understand it again. But it was really a year where it was pretty benign, right? Pretty calm. Last year we saw that, like, this was 2017. We did not have a correction for the year. The longest drawdown took place over the span of a little less than a month in July and August. A little less than 8.5%. A lot of that pulled into that August 5th day. Market was up much more than the traditional 51% of the time, right? Almost 6 out of 10. It's a good way to be investing. Good time to be investing. Much better than your FanDuel bets, which are probably closer to 50-50 if you're lucky. And the worst performing sectors, again, for the most part, I would argue that essentially worst performing being flattish to slightly up, not a bad place to be. Here is the drill down on the whole sector story. This is in Q4. Matt, you can hop to that next slide. We can see quarter to date energy materials to the commodity complex did not have a great year on the basis of the prices of the stocks. We'll come back to that in a moment when I hit the commodity section. The best performers in here, again, consumer discretionary, which that's where you find Amazon, but also Tesla, which ripped after the election as Elon has become, Trump's key bedfellow these days. The worst performing healthcare and again, materials. Real estate was hit by the rising interest rate environment that took place from pretty much September through the end of the year. But again, across the board, pretty solid looking picture. I'm not going to go ahead and get into the valuation stuff at a sector level. We'll spend some time on that in a moment. But again, this is an eye chart. There's a ton of good data in here. Matt, let's hop to the next slide. I like this one a lot. This is the heat map. Again, this looks at the last 90 days. You can see towards the lower left-hand quadrant, it's the financials, a lot of green, not much in the way of red. Tech was kind of a mixed picture. So Apple did not have a great last 90 days. Some of this spills actually into 2025, where Apple's giving back a little bit. But again, it wasn't Microsoft or Nvidia as much as Broadcom, which is AVGO, and then a couple other names that clearly quite well: Amazon, Google, Meta, and Tesla. Tesla nearly up 100% in that fourth quarter. Again, if I look at this from quarter to quarter, the heat map or the hot red areas change from one quarter to the next. This is just, again, a story of why diversification matters, folks. But again, a nice way of looking at the market. These are the S&P 500 constituents. Here's the piece that we, I don't say harp on, but we spend a lot of time on. And it's critically important to understand. Valuation matters, right? The price you pay for something today will derive or provide a bit of visibility to your future returns. The market today is at 21 and a half. It's a good, couple standard deviations above its long-term average. The 30-year average is about 17. The long-run average is closer to about 16. Again, doesn't mean that we should run out and sell our stocks. It just means that like our forward returns are probably going to be a little less exciting than the 20% we've seen in the last 2 years, or the 13+% compound that's been the case for the S&P post GFC. The dividend yield on stocks, it's something, dividend paying stocks had a tough year in 2024. A lot of that's considered them our bond proxy. So as rates went up, that pushed the stocks down quite a bit in the fourth quarter. But your yield on the S&P today is about just under 175, 180. Again, pretty paltry, right? I remember days when the S&P yield's close to 3 or 4%. But again, it's not to say valuation is going to tell you what's going to happen tomorrow, but just again, a good guide for what to think about over the future. We'll come back to that point in a later slide. Earnings, again, I mentioned this earlier. Earnings estimates for the fourth quarter are 12.5%. For the whole year of 2025. Closer to about 14.5, 15. I know this slide says 17, but I'm looking at FactSet, who I just think is a better resource than we're seeing here at JP Morgan. Why this is nice, this breaks down where you're going to see a lot of that earnings growth. The worst performing from an earnings growth perspective is set to be real estate, excuse me. And everything else is, mid-teens to even, scraping into the 20s. So, if earnings can deliver, stocks can go higher. If earnings fall flat, we're at a pretty lofty level here from a valuation perspective. If you drill down below this to shareholder yield, because everyone thinks a lot about dividends, but companies are or have been for a long time buying back stock. It's kind of an easier way to deploy capital, improves your earnings per share without necessarily sticking your neck out, making an acquisition, doing a significant amount of capex. You can see, the earnings yield. The largest is the energy sector, which has a fairly generous dividend policy. The cohort is roughly about 3%, and they're buying back still around 3 to 4% of stock, much different than the mid-teens where it was all about drill and produce. And then the other end of the spectrum, tech and consumer discretionary, their total shareholder yield is quite low, meaning again they don't do a whole heck of a lot of dividend paying or buying back stock. Although Meta and Alphabet both announced dividends last year. I think Amazon's the last man standing here. We'll see whether they institute a dividend here in 2025. But again, why that matters is if you look long run, S&P's return has been about 10%, about 40% return historically comes in the form of dividend. Knowing yields are only about 2% today, you got to expect that if that same story plays out, it'll be about 2% in buybacks, about 2% in dividends, and then the remainder 6% or so in price change. Maddie, we can hop to the next slide. Um, Again, the earnings growth picture, 2023, margins had compressed quite a bit. This was on the back of that inflationary challenge. We saw margins improve in 2024. There's some limits to how far margins can go. AI is likely to be a big driver of improved margins. But whether or not that makes its way into the entire ecosystem is TBD. As of right now, a lot of that stuff is very early days, and isn't necessarily making it that far out of like the call center environment. But margins, roughly speaking, at 8%, or improvement on EPS growth, 8%. That's impressive. Margins collectively are close to about 13%, not quite the peak of nearly 14 we saw back in 2021, but historically quite high. If you look again, long on average, our margins are somewhere in the 10% territory. Revenue, again, if nominal growth is like 5 or 6%, right, which is the real GDP plus inflation, we should expect revenue growth this year, and we're optimistic that's going to be the case as animal spirits come back into the economy. And then share count, again, for the last couple of years, there's been a penalty by way of a Biden legislative piece, which would assess surcharge for buying back stock. That will be repealed, and as a result, you likely expect some increasing buyback activity. Although again, we don't necessarily want companies buying back their stock at all-time highs if there's better use of capital. Let's go to the next slide. Valuation is, something I highlighted before, but valuation, if you look at it from the standpoint of understanding constituents of the market, value versus growth, value stocks are about as cheap as they've been versus growth going back, probably to 1999, 2000, right? And if you remember the post internet bubble period, the value stocks had a really nice run for about 6 or 7 years before the GFC. Again, we're not trying to say history is going to repeat itself. It does have a tendency to rhyme. And now, if you look at a world where interest rates are likely to be higher, which again is kind of the new normal, right? Yeah, expectations are, probably the 10-year Treasury in that 4% territory plus. Value stocks tend to either do as well, if not better, than growth stocks. Based on where valuations are today, it's sort of safe to say that that's a much better tailwind to value versus growth stocks. Where growth stocks tend to significantly outperform is when interest rates are really, really low, right? It's kind of a concept of duration, right? Growth stocks will earn a lot of money in the future. If interest rates are zero, there's no opportunity cost today. We do see interest rates today, in that kind of 3 to 4% on the front end, and then 4 to 5% on the long end. Let's go to the next slide. Again, small caps, I think I've probably been stubborn on this, for a couple of years. The reason being is, I do think the economy is dynamic, and I think that a lot of what we see from, what drives the country forward is small business. This doesn't necessarily mean it's, a mom and pop shop, but these are businesses that, market caps are under $2 billion. There's a part of that market that surely is unprofitable, right? As you can see, it's about 40%. But truth be told, again, those are some of the most innovative companies in the world of technology and biotech. If you look at the small cap market and you look at the S&P 600, which has a profitability guide, those stocks trade around 14 times. Again, pretty darn inexpensive. When you look at the market, broadly speaking, around 22 times, or growth stocks trading closer to 38 times. Mid caps also are actually pretty inexpensive. It's kind of the Jan Brady phenomenon. We've talked about that in the past, where again, everyone loved Marsha, the pretty older sister, and doted on Cindy the baby. But Jan brought a lot to the table, and I could say the same thing about mid cap stocks, which are again consistently more profitable, bigger, and thus more resilient. And then again, their earnings expectations are pretty impressive for 2025 and 2026. I'll go ahead and hop to the next slide. Again, just if you look at the right-hand side, you can see clearly that the number that's in the upper left-hand corner is where we are today. Lower right-hand corner is for each box, that is the historic average. So when you see like a large growth, 28.9 over 19.3, basically saying growth stocks trade around a 50% premium of their long-term average, right? 50% premium, you heard me right. Small cap stocks, again, trade pretty close to their long-run average. I like paying close to fair value. I don't love paying 50% more than I think something's worth. Again, we own growth stocks. We believe they're an important part of the portfolio. We just wouldn't want to be as overweight as we see some people today, where if a couple things don't break right, it could be a more difficult period ahead. We'll hop to the next slide here. Rounding out, kind of asset classes domestically, we'll talk about commodities here. So you saw before, energy stocks were down. Interesting enough, energy prices were up. Sometimes one of those, strange things that happens with the commodity marketplace. A lot of that was on the back of concerns about supply, right? Sanctions on Russia were dialed up. We saw that with Biden as he left office. And then, there's clearly an intent on the new administration to push harder against Iran and Venezuela in particular. So as supply might come out of the marketplace until we get the Saudis or the US to be able to produce more. And I'm not sure we're going to do more in the US. We're seeing a little short-term upward price pressure on oil and gas. And again, the cold weather doesn't help that situation either. On top of that, you can make the case that the capital discipline that's taken place over the last few years has made it less likely that you're going to see a significant amount of excess supply into the marketplace in the near term. Gold, which was a popular trade for much of the year, Maddie, I'll come back to the oil in a second, but gold actually didn't have a great fourth quarter, surprisingly. Had a pretty good year. Why gold probably sold off a little bit in the back half of the year or the fourth quarter was a combination of higher interest rates, right? That kind of opportunity cost, an ounce of gold. 10 years from now, what do you got? You have an ounce of gold, whereas the yield on stock or a coupon payment on bond. And then again, I think there's a little bit of a vacuum effect where investors were pushing assets, pushing money into the digital currencies like Bitcoin, Ethereum, so on and so forth. Again, industrial metals, not a great year, largely in the back of the fact that demand from China has been pretty slow. Collectively, you'd think that the discussion or the area where we're likely to see some moderation in inflation next year is probably in agricultural commodities. Could be a little bit offset in the short term by that little tick up in oil and gas prices. But again, on balance, I would think there's a little bit of downward disinflationary pressure on commodities as a whole. In addition, I think real estate will continue to be a positive catalyst relative to seeing that inflation story come back down. We'll close out on the oil page here, and I'll kick this over to Tom in a second. Again, U.S. production is impressive. We are essentially the peak producer. We're producing something in the neighborhood of about 23 million barrels a day. OPEC as a group is producing more, but that's incorporating, I think it's now 11 countries. We're about 2x what Russia produces. We're about 20% more than what Saudi Arabia produces. I'm not expecting us to bring on a whole heck of a lot more oil. I know, President Trump believes that drill baby drill is going to create a windfall, a benefit to the consumer. I don't know how well that's going to help oil or energy companies, but we're pretty close to peak production. It's going to be a challenge to go ahead and see that number tick up. So hopefully we'll have some help from our trading partners in OPEC and elsewhere. Consumption, again, expectations in the U.S. are pretty flat. Again, makes sense. Our economy is pretty mature. We've seen more of adoption of EVs and whatnot. You look at China and India, again, their oil and gas consumption is likely to jump sharply as they continue to build out infrastructure. So again, I know energy gets a lot of airtime. It's a very small part of the market. It only represents about 4%, 5% of the S&P. But we figured we'd spend a minute or two on oil and gas. I'm going to turn it over to Tom. Tom's going to take us through international and then fixed income, and then we'll go from there.
Thanks, Jeff. Appreciate it. As Jeff mentioned at the top, I get the two sections. I would say that we saw some volatility, saw some negative returns. So we won't kill the presentation with lots of time necessarily on either one. But I do want to highlight, as you look at the global equity markets, there were a few countries that kind of hung in there in the fourth quarter last year. Japan had a nice quarter, positive 5.3%, Germany positive 3%, Italy positive 1.4%. Just about every other country or region was negative. Leading the way on the negative front was the Latin American index, and really just Brazil, Argentina, Venezuela, bogged down by inflation, currency devaluation, economic instability, hyperinflation in Venezuela, political repression, just a lot going on, in those countries. And a lot of things are going to have to happen for it to turn around: structural reform, fiscal responsibility, really more investment in infrastructure, and getting the kind of politics squared away, hopefully, will help each one of those countries individually and overall Latin America. Maddie, if you don't mind, jump to the next slide. A little picture of global inflation. So still a wide range. If you look at the chart on the right-hand side, Russia, 8.9%. Obviously, the war in Ukraine is still going on, and it is impacting the Russian economy significantly. India, Brazil, following up, and then, Japan at 2.9, US 2.7, so more in a reasonable range. If you look down at the bottom of the chart, China at 0.2%, and I'm going to spend more time on China, not only because it's the second largest economy, but also because I'm fascinated by China, and I think it just is such an interesting story right now. But 0.2% obviously is not much inflation at all. And as you see in the next couple of slides, we'll talk a bit more about what's going on. Maddie, if you don't mind, jump to the next slide. On the right-hand side, I like this graph because it talks about just imports by country, and you look at China being that red line where 2016, 2018, there was kind of a peak of US goods imports, and it started to go down. If you look at what's going on in China in general, like with their exports, they're ultimately trying to grow out of a difficult economic period. And part of the tariff idea, which Maddie hit on, is we can't have world financial markets and world goods kind of flooded with what's going on with China. So there's some kind of back and forth, with each country, not just the United States, on like, how do we control, not every EV coming from China because they're boosting their production because they're trying to boost their economy. So there is a bit of a give and take as it relates to tariffs. If we look at the next page, just some of the headwinds that are facing China. So 2 years of falling producer prices. So they're not able to sell their goods at higher and higher prices. So they're actually falling, which is not a great sign. Between 2010 and 2021, labor costs in China increased by almost 40%. So part of that is driven by that chart on the upper left-hand side, which I know it's a little bit small, but it's China's working age population. So they're essentially getting older as a country. If you look in the year 2000 versus 2024, there were 10 workers for every one retiree in 2000. Now there are 5 workers for every single retiree. And the replacement rate, as far as like the birth rate, has dropped below replacement rate. So 2.1 is really a replacement rate, and so they're not replacing workers, and and they haven't been for a long time, and ultimately, it's not as noticeable when it's kids, but once they age into the working population, that's where it starts to have a real economic impact. And that's what we're really starting to see and have been seeing for probably the last 4 or 5 years. And with COVID, a lot of the economic data was murky, muddy. You couldn't necessarily separate one thing from another, but we're starting to see it on the demographic side. The real estate bust is still going on, where they have just an extraordinary amount of vacant units. It's like 80 million vacant units, which equals half of the total number of housing units in the United States. So just a massive, massive glut of empty actual housing units. It's crazy. Chinese debt, as far as just the percentage of GDP, which is that chart on the lower right, is nearing 300% of their GDP. And if you look at, every country is a little bit different as it's constructed and the different kind of pieces that matter. But the Penn-Wharton budget model has essentially said that the US shouldn't exceed 200%, right? And if you look at it, really the expectation is by the year 2034, we might be in the 116%. And as I mentioned, China's nearing 300% of GDP, so massive amount of debt. If you don't mind, Maddie, flip to the next page. As far as the global central banks, so everybody's really reacting to their own situation. There's unevenness as it relates to policy. We've kind of beaten up or looked closely at the Fed funds rate. That's the one that impacts us the most. But you can see the ECB. You can see Bank of Japan actually is the only country that's really kind of raising rates because their economy has been doing so well. And if you look at China, the yellow line is not flat. They've been reducing rates, but not at a breakneck pace by any stretch of the imagination. So, if you look at just certain economies being a little bit more accommodative, right? And you can see on the right-hand side where it's the balance sheet, and we'll spend a little bit more time on our balance sheet in the fixed income section. But if you see the line going down and to the right, essentially it's quantitative tightening. So they're letting things roll off the balance sheet post 2008. As you look at both China and also Bank of Japan, they're a little bit more level and maybe even easing a bit as far as when you look at China specifically, the yellow line. On the next slide, Jeff hit on this, so I won't spend a ton of time, at least on the domestic side. The global equity valuations are better, right? And part of that is we haven't seen the exceptional outperformance like we have seen in the US over the last couple of years. But if you look at the PE ratio versus the 15-year average, so in the EFA, it's 14 currently versus the 15-year average, 13.8. And then you look at emerging markets, 11.8 versus 11.4. Versus again, the S&P 500 is up over 21% compared to the 15-year average at 16.7. So it's just important to look at, I would say international stocks as well as fixed income, which we'll talk about in a minute, play an important diversifying role within portfolios, and it's important to still own them, even though you go through periods of time, where you see a little bit more volatility, which we definitely have over the last quarter. Next slide, we're going to shift gears over into fixed income and really just the income index returns. If you look tougher quarter again, in that 3-month column, really all the core bonds in the upper left-hand side, all negative, not massively negative. Ultimately bonds play a stabilizing role within portfolios. And even when they go through a tough stretch of time, usually it's not massive downs. The more aggressive you get, so if you move to that lower section on the left-hand side where it says aggressive income, you may see more volatility periodically. Sometimes they'll still be positive, like many of them are right now for the last quarter. But in the end, again, meant as a stabilizing presence within a portfolio and diversifier, so that we're not just subject to both domestic and international equity markets. If we look in the next page, so the Fed interest rates, Jeff touched on this to some degree, expecting a shallower path as far as what the market expectations are. The Fed still has long run projections to say, hey, we want to be around 3%. How we get there, when we get there, is going to be determined by the economic data. There are things like immigration policy, the tariffs, are both very inflationary. So that'll actually have a decent sized impact on what the Fed ends up doing, as well as, on the next page, we've got a little bit more on the Federal Reserve, the balance sheet, as I mentioned. The Fed we're in a quantitative tightening cycle. So if you look at the last line there on the kind of the inset table, really since May 2022, when it was announced that the Fed has just let assets essentially roll off the balance sheet. So if you look at COVID, that was a massive peak as far as the Fed trying to ease everything to make the flow of money easier, to help the markets, to help businesses, which was a good thing. if you think of rates coming down and you think of quantitative tightening, you might look at it and say, well, aren't we, loosening in one area and tightening in another area? Are they offsetting? And essentially, no, not yet, because the balance sheet got so big that there's still an abundant amount of assets on there. So it's not having an equal impact as far as tightening versus, again, cutting rates on the loosening side. So it'll be a little bit more time as they let assets roll off that, we won't see necessarily that economic impact, but it's interesting, I think, nice picture and a good thing to be aware of, because as those assets do continue to roll off, there may be a more outsized impact over time. On the next slide, just a quick peek at fixed income yields. So if you look at the kind of charcoal bars, that's the range over the past 10 years as far as where, if you look on the x-axis there, the U.S. Treasuries, municipals, mortgage-backed securities, kind of the core bonds, and then over into the extended sectors. Those are the ranges. The purple is really the 10-year median. And then the blue diamond is the current level, right? So where are yields? They're actually, historically within the last 10 years, they're pretty high. They're not the highest they've been, but they're on the higher end. And that's just, again, something that we're paying attention to is yield, duration, how is the bond portfolio within your greater portfolio structured? If we jump to the next slide, just quick on cash and interest rates. So as interest rates have declined, cash is starting to decline as well. So any money markets that we're sitting on, the yield is creeping down. And that's just, again, something to be aware of. And as we look at, where we keep our cash, as we look at, potentially investing some of that into more intermediate bond type areas, to make sure that we're maximizing yield and return. It's just something that we're watching. Next slide and final slide that I'll cover is again just a diversification slide. As you look from the left-hand blue column, that's 100% stocks going all the way down to 40% stocks, 60% bonds. I love talking about this with clients. The best period of time, the worst period of time, and the average rates of return over time. As we all get older, as we all get closer and closer to potentially needing to tap into our portfolio, we take risk off the table. We add more bonds. We give up some on the average return, but the idea is that we're kind of tightening the band as far as how much risk we truly want to take, because we don't want to be dipping into the portfolio as much as possible if we do go into any kind of negative markets. Ideally we're not selling at that wrong time. We want to make sure that we have adequate cash reserves and again an asset allocation that will support any income we need to take from our portfolio. Based on that, or really just to wrap up my section, I'm going to pass it over to Maddie to continue to talk more about asset allocation.
Everyone's favorite topic. So really this, highlights what this means for everyone on that call, on this call, and everyone's different. But this first chart here looks at a comparison and provides a historical and forecasted annual total returns across different asset classes, not just the bond market, but stocks, small caps, international, US large caps. So as we see the expected returns for all asset classes from 2025 to 2034 are lower than the historical averages observed from 1970 to 2024. US large cap stocks, for example, historically returned 10.9% annually, but are now forecasted at just 6%. If we look at a similar story with small cap stocks, international large cap stocks show a noticeable decline in expected performance. Bonds and cash are also expected to generate lower returns. And the shift highlights the impact of macroeconomic headwinds that I discussed earlier in the call, including higher valuations, slowing growth prospects on future returns. Also, this slide underscores the importance of thoughtful asset allocation and making sure that you approach your portfolio in a diversified way and managing expectations as we navigate a potentially lower return environment in the coming decade, now doubling your money over possibly from going to 12 years instead of the 7 that we've seen in the past 10 years, so to speak. And if we look at the next slide here, this slide highlights the performance of different investment opportunities during peaks or periods of peak 6-month CD rates across various rate hiking cycles. And I thought this was important to highlight because we get a lot of questions on, well, why wouldn't I just buy a CD or a US Treasury? And I think that this slide speaks directly to that. The gray bars represent the peak CD rates during each period, while the other bars show the subsequent 12-month total returns for various asset classes like the US bonds, S&P 500, and a standard 60-40 portfolio. And if we look at the most recent cycle from September 2023 to September 2024, the peak 6-month CD rate reached 5.4%, offering a 7% return over 12 months. If we look at alternative investments like the S&P 500, a 60-40 portfolio generated significantly higher returns of 36% and 26% respectively. The trends highlight that while CDs may provide a guaranteed return, diversifying into other asset classes during such cycles can often lead to more attractive returns. And certainly, hopefully, it reinforces the importance of maintaining a well-balanced portfolio, even in periods of rising interest rates. And if we look at the next slide here, this slide demonstrates the relationship between time diversification and the volatility of returns across stocks, bonds, and a 60-40 portfolio from 1950 to 2024. The chart on the left shows the range of annual total returns for asset classes over different time horizons between 1 year, 5 year, 10 year, 20 year rolling periods. And something to look at, you can see stocks that are in green exhibit the highest volatility in 1 year returns ranging from negative 37% to a positive 52%, really riding that roller coaster. If we look at the holding, as the holding period increases, though, the range narrows pretty significantly, with the 20-year rolling return ranging from positive 6% to positive 18%. Illustrating how time reduces the impact of short-term volatility in equities. So making sure that you're staying invested and that your portfolio is really reflective of your financial plan, not timing the market. If you look at the blended 60-40 portfolio in gray, that shows lower volatility than stocks alone with a narrow range of returns over all time horizons, over all time periods that are showing there, further highlighting the benefits of diversification. Bonds in blue offering the lowest average return at 5.2%, but certainly they demonstrate the least volatility across all periods as well. And then the table on the right reinforces this point, showing the growth of $100,000 over 20 years. Stocks provide the highest growth, turning that $100,000 into $895,000, while the 60-40 portfolio grows to $600,000. Certainly maintaining a balance between risk and return. And the key takeaway really here being staying invested for the long term and diversifying to manage volatility and achieve consistent growth. And the last slide here, before we let Jeff summarize the whole deck, illustrates the percentage of time the US economy has spent in recession by decade since the 1900s. So you can see the early 20th century, particularly the 1910s, 20s, and 30s, experienced significantly higher proportion of time in recession, with peaks of 45% in the 1910s, 44% in the 1930s, driven by major economic disruptions such as World War I, the Great Depression, and other systemic challenges. If you move into the mid-20th century, the frequency of recessions you can see is declining, with the 1940s through the 1960s seeing much lower percentages of time in recession, reflecting a period of economic expansion post-World War II. The 1970s, 1980s show an uptick due to stagflation, oil crisis, and structural adjustments. And then if we look at the 1990s, the economy becomes more stable, with only 7% of the time spent in recession. In the early 2010s, recorded no time in recession. And then if we look at the 2020s, despite a strong start, show 3% due to the COVID pandemic sharp but brief recession. And obviously, overall, hopefully this slide demonstrates the economic environment has evolved over time with reduced time in recession in more recent decades, reflecting improved economic policies, diversification, and globalization.
Thanks, Maddie. Tom, Maddie, appreciate you guys taking us through this. I'm going to just quickly come back to a couple slides that stuck out to me. I'm making notes, even though I've seen this deck now for a couple weeks. I do want to come back to that recession slide first, though. I think it's something like 90% of the time we spend worrying about recessions, but in reality, they are few and far between. And part of that is probably just the fact that our economies are much more dynamic and reactive today. You know, if you go back to the 1920s and 30s, those boom bust cycles were far more prominent. That the economy was much more reliant on manufacturing, and we're talking about like cotton gins and steam engines. And today, you know, we have the ability to manage supply chains with barcodes and you know, stuff that just really makes these periods, which again, I'm sympathetic with those folks impacted, fewer and hopefully much less shallow. Again, a couple of quick points before I get to the actual summary slide. You know, it's mind-boggling to think that you know, we have $1 trillion of our $7 trillion budget is spent on debt service. That's $3 billion a day that just goes to interest payments. Again, I kind of yeah, anytime I see that, I'm just breathtaking. You know, just kind of shocked. You know, clearly the uptick in credit card defaults or delinquencies is something we're monitoring. I know there's been a new phenomenon. I remember from the 70s and early 80s as layaway. Now it's buy now, pay later. The data there is actually been better than you might expect, despite seeing some delinquencies in credit cards. But we're watching that stuff as we watch subprime auto loans. Housing, again, is really not going to tell anything like it did in the last go round when we saw, you know, that being a bit of the canary in the coal mine. Um, you know, just on the comments about quantitative tightening, Tom had taken us through the slide. And one of the reasons why I think mortgage rates are higher today and the spreads wider versus the Treasury is the Fed was a really big buyer of mortgage-backed securities through that quantitative easing phase that took place post GFC. And as they've allowed mortgage bonds to roll off at a greater rate, you know, they've really kind of taken a big buyer out of the marketplace. So again, I'm not sure that's going to change anytime soon, but as you know, their pressure of that debt rolling off starts to dissipate as their portfolio winds down, maybe that again will change the dynamic a little bit. Um, the one slide that really we could have probably spent an hour on is tariffs, and I think a lot of people are very concerned, or at least interested as to what plays out. The market responded well yesterday, the first trading day after the inauguration, mainly because we didn't announce you know, massive tariffs on China. Yes, there was some intimation that Mexico and Canada better be willing to come to the table. Remember, the USMCA, the newest version of NAFTA, which Trump renegotiated in his first term, is set to be revisited in 2026 anyway. So I'm not sure that's anything that's all that surprising. And it's a lot more probably bluster than bite. You do have to take him seriously, just not literally. That's a key phrase I've heard a couple people say. But looking at the last slide here, yeah, policies matter. Policy matters. It's funny because, Matt, if you want to hop to the next slide, you know, I think we're all kind of happy to be done with the election. But you know, the days of fighting in Washington are not done. We've got a debt ceiling discussion that will be on the docket here in the next couple months. You know, the Freedom Caucus, about 10, 12 Republicans in the House have a lot of influence because the majority is so modest. So we'll watch the policy backdrop. You'd think that an environment where the Republicans control both chambers of the House, both chambers of Congress, the House and Senate, as well as the White House, that it'd be easier to get things done legislatively. We'll see. The dollar has rallied significantly over the last few months. I do expect that to kind of reverse here. It could be a combination of us maybe being a little bit easier on monetary policy, a little less aggressive on tariffs, could be a little bit better catch up by way of the overseas economy is doing a little better. So again, to be something to watch. I mean, it's great if you're looking to travel to Europe where the exchange rate is basically at parity now, but a stronger dollar is not a great thing for a U.S. economy that's trying to bring more manufacturing back here. Again, I do think that we have to spend a ton of time as investors focusing on earnings and the capacity for companies to keep growing their earnings. And as you're bigger and bigger trillion-dollar companies, the ability to continue to grow earnings at 10, 20, 30% becomes more and more challenging. So I think those mid and smaller size companies are more likely to hit their numbers and perhaps exceed them. We'll be able to, kind of wind down our tenure with Jay Powell as he's finishes his second term in May of next year. By the fall, we'll likely have an announcement as to who the next Fed chair is. It's no surprise, it's probably going to be Kevin Warsh. But Powell is really, I think, focused on having his legacy be one where he was able to navigate the pandemic and then a soft landing. So I expect the dove that is Jay Powell to be on full display this year. Probably not in the January meeting, but come March, they take February off, hopefully in some warm weather locale. Again, we talked a lot about China. If China can find a way to stimulate their economy and get internal demand going, you can be a little bit more constructive. If they're going to continue to push on a string as they have been with monetary stimulus, much like Tom talked about, the challenges there are really, really difficult. I wouldn't say insurmountable, but enough to make us, kind of sit on the sidelines. I expect the war in Ukraine to end this year. Again, I don't think that's a particularly out of consensus call. That could be a very good outcome for Europe. Just simply as they bring gas back online, which has been the big driver of their inflation there. And then I think that gives the ECB a lot more runway to cut rates. Crypto, happy to offer my 2 cents. Not an expert by any stretch of imagination, but there's definitely some signs of bubbles there. The good news, I might say, is in the past you had one place to go for bubbles, kind of the stock market, but we see bubbles in different pockets of the capital markets, whether it's again crypto, some of the meme stocks, even the private markets to some extent. So to the extent that there's pockets of complacency that aren't just in mom and pop's S&P, I think that could be a good thing. Where we get word is if everyone's crowded on the same trade. So on balance, again, a good year in 2024, not a great year. Probably would have been great had we not had the December sell-off. We're expecting a solid year in 2025. I don't think it's going to be the same story that was what we saw in 2023 and 2024, but stay tuned. And again, we appreciate your trust. Thanks for those of you who are our clients today. And for those of considering working with Breakwater Capital, we welcome your calls, your input, your questions. Thank you so much. Have a great day.